Working capital and requirement for working capital. The operating cycle of working capital is the period of time between the first payment relating to the manufacture of a specific product and the receipt of cash from a customer for that product. It is a measure of working capital efficiency and is sometimes known as the cash conversion cycle. Companies will therefore allocate some of their cash to finance stock levels throughout the manufacturing process, from raw materials to finished goods. Cash may also be needed to bridge the gap between the delivery of the finished goods or services to a customer and the receipt of payment for those goods or services from the customer. This money is known as accounts receivable. Short-term funds, typically in the form of bank overdrafts, may be needed to sustain operations where the levels of working capital fluctuate within the operating cycle. Working capital requirement. Investment that an organization makes within the operating cycle is known as the working capital requirement, or WCR. Working capital requirement equivalent to current assets divided by current liabilities. The difference between an organization's working capital and its working capital requirement is cashless, short-term financial debt, such as a bank overdraft. The normal method for financing an organization's working capital requirement is via bank overdrafts. An overdraft offers flexibility and accommodates the fluctuating nature of net current assets. In addition, short-term financing tends to be available at a lower cost than long-term financing. While the interest rates on short-term loans may initially be higher, long-term loans allow interest to build up over time. Long-term loans are generally used for structured finance and are not used to fund working capital. The working capital ratio tends to be positive in most manufacturing companies. The smaller the WCR, the less total financial resources needed, and the stronger the company is as it needs to borrow less money externally. Some businesses may have limited stock. They may also have no accounts receivable as they do not extend credit to customers. But supermarkets do not hide accounts payable. The WCR for such organizations is likely to be negative. Remember, accounts receivable is the money to be paid into a company, while accounts payable is the money owned by the company. Working capital policy. Individual company objectives will determine what working capital policy is adopted. The organization's objectives are often influenced by the nature of the business and the sector, whether commercial or industrial, in which the business operates. When creating objectives, a balance has to be struck between the disparate goals of profitability and liquidity. Operating cycle. Time required for a business to receive cash, make goods, sell goods, and make cash. Working capital requirement, or WCR. Funds that a company must keep available in order to pay its obligations. Accounts payable, money that a company owes. Working capital policy refers to the level of investment in current assets for attaining a company's targeted sales.